What's up everyone? Happy Friday. Thanks for tuning in. My name's Mike. This is my whiteboard, and today I'm going to be covering a concept that I think is really important for a lot of us traders where we're trading in a smaller account. So that's exactly what we're going to talk about today. I've been trading on the Do Follow page for probably between 6 and 7 months. So if you haven't seen any of my trades or any of the other trades from a lot of our other talent on the network, definitely check it out. It's totally free. You can just go to do.com and check out the follow page there after you create a free sign-in. But in all reality, I've been trading in a $10,000 account, which is very transparent on that site. You can actually look at the account sizes and the risk profiles for each of the traders on the follow page. So I've been trading in a $10,000 account, and I've been doing that for about 6 or 7 months. I had a trade that took me down really hard and brought me down about 10% right from the get-go. But since then, I've been climbing back up, and now I'm net positive in the account overall. And I wanted to really talk about a few keys that I've been focusing on that I think really helped a lot when I was making these trades and controlling the environment that I was trading in that smaller account. So if we go to the next slide, I want to really point out that when we're trading in a smaller account, while it is a little more difficult, there are a lot of benefits to trading in a smaller account. The very first one is that it's a good learning tool. So as we're trading and as we're learning about this alternative way of trading and trading options and trading in a high probability using statistics, what we really need to do is put it into practice. So we might learn something by watching a show or reading something on an article, but we really don't understand how it truly works until we trade. And I tried paper trading originally, and that gave me a good understanding of the platform, but I didn't have anything on the line. There wasn't anything at risk. So really when it came to understanding and learning from my mistakes or learning from situations that worked out, I didn't have as great of effect as I did until I started trading real money. So when we're looking at smaller accounts, it's a great learning tool, and it really helps us stay engaged and really focus on exactly what we're doing. And at the end of the day, it's a lower capital loss potential. So if I'm trading a $10,000 account or even maybe a $5,000 account or less, if I end up blowing that account because I make a lot of mistakes, it's okay because it is a smaller amount of capital. It's not my 6-figure IRA account that I don't have, but hopefully in the future I will. So it really is a way to learn and use trading and really get to learn these things so that when we have the capital to do so and take our finances into our own hands, we have the tools and knowledge to do so on a much higher level and hopefully beat the market year in and year out. So I wanted to point these out just to highlight the fact that there are a lot of benefits to trading in a smaller account, although it can be difficult. So let's move on to our first key when we're trading in a small account, and something that really helped me out when I was trading over these past 6 to 7 months in a smaller account. So really the main key when we're trading in a small account or a big account, and I think this is the most important thing overall, is to trade small and staying small in our position size. So ideally, we would like to stay between 1 and 2% or less than 5%, I would say, if we're going really extreme, less than 5% of our entire portfolio in each trade for buying power reduction. So what does this mean? Well, if I have a $100,000 account, that means that if I'm selling premium or I have a trade on that takes $5,000 in buying power or less, then I'm staying within this range. But if I only have a $10,000 account, that means I need to focus on trades that give me a buying power reduction or take a buying power reduction of around $500 per trade to stay small enough to withstand certain things that might happen. So if I have a bad trade go against me, I want to be able to make sure that it doesn't totally delete my account or paralyze my account because I traded too large. So when we're looking at smaller accounts, it is going to be harder to trade small in that 1 to 5% range. So there's a few things I want to point out that will definitely help to keep that small range available. And the number one thing is defined risk. So we talk about naked options and the benefits of naked options, and they are all true, but defined risk for a smaller account can actually be a very useful tool because of the fact that it helps us stay small. So I can look at much larger underlyings like Apple or Amazon or Google, and I'm able to sell things like 3-point wide spreads or 5-point wide spreads for $1 or maybe $1.50 if I'm getting closer to the stock price. And I'm basically controlling my max loss to something around $200 or $300, which means that even if the trade goes totally against me, I'm only going to lose that specified amount. So defined risk in a smaller account is certainly key, and it helps us really learn the ins and outs of trading while keeping our risk defined so we can sleep well at night. And also, defined risk is pretty easy to obtain when we're looking at a brokerage perspective. So we have to have permission to trade options from the get-go, and with TD Ameritrade, it's tier 2 with defined risk. So it's something that we can obtain using our dojo certificate as well. So if you are having trouble with tier 2 approval, we can go through the dojo and submit our certificate to TD Ameritrade. It's not guaranteed that it's going to give us that, but it certainly helps out. And another thing I want to point out is low-priced underlying. So we really like naked options for the benefits that they offer. We can collect more premium, which ultimately increases my probability of profit. And we have the ability to roll it if we run into trouble with the trade. So if we have a trade go against us, it's much easier to roll an undefined risk trade or a naked option trade for a credit when we compare it to a defined risk trade. Because a defined risk trade, basically, in order to roll that for a credit, we need the stock price to be right around that short strike near expiration, where with an undefined risk or naked trade, the stock price can be anywhere. As long as if the option's in the money, the stock price can be anywhere, and I can roll it out in the future for a credit because I'm not really dealing with that long defined risk aspect of a naked option trade. So when we look at what we can do with naked options in a smaller account is we can look at underlyings that are much smaller in notional value. So what I mean by that is just underlyings that are trading for a smaller value. So things like Groupon or maybe RIG if we want to get involved in the oil markets, or CHK is another great one. These are all things that are trading for 5 points or 6 points. So I can sell premium in there, and at the end of the day, if the underlying goes bankrupt and it goes to zero, even if I sell a naked put at the strike of 5 and maybe I collect 20 or 30 cents out of doing that, I would only lose about $470 if the underlying went literally to zero for every contract that I do that for. So it's another way that we can get involved with naked options and really understand how naked options work by trading lower priced underlyings. So when it comes to staying small, I think these two things have helped me out the most when it came to really managing my portfolio as I am currently. So let's move on to the next key, which is going to be the strategy selection that we choose. So I know we have a lot of different strategies, and with options, because we have so many different variables and so many different things we can do, we can create a lot of different strategies. But really when it comes down to focusing on a strategy, I think it's really key. So if you attribute this to anything else in life, if you spread yourself too thin across anything, maybe it's work or different hobbies you're trying to get involved in, the more you spread yourself thin, the harder it is to really focus in and understand on any of those things. So if we focus in on just a few key strategies, we can really hone in on those things, understand how to get into those trades, what are the things we look for, understand how to get out and when we really choose to get out, and more importantly, understand how to manage those positions when they go against us. So for me, my main strategies are selling naked puts in lower priced underlyings. I also like to sell vertical spreads, and I'm really digging the diagonal spreads. So long, poor man's covered call or a poor man's covered put. I really find those to be really attractive for small accounts because it allows me to have that directional assumption with the trade, and if we're in a lower IV environment like we are now, it allows me to benefit from an IV expansion if it does come to fruition. So really, when we're looking for strategy selection, I think it's important to pick a few strategies. Maybe pick 1 or 2 or 3 strategies that you want to focus on, whether they're directional or non-directional. It's really important to just focus on just a few strategies, really master those strategies, and put them into practice so that you can really understand what's going on. And once you do that, it's much easier to branch out into more complicated strategies like broken wing butterflies or ratio spreads. So I would say to really focus in on just a few strategies, and we really don't need to be crazy about strategies to be successful. A lot of the rising stars you see that come on the Taste Trade Network, you might see them just trading iron condors or just trading strangles, and really just understanding and knowing how to manage those perfectly is really what they're doing and how they're so successful in doing that. So we don't have to be crazy with strategy selections. I would say just pick 1, 2, or 3 strategies you want to focus on in a smaller account, and especially when we're just starting out and learning, and going from there. So let's move on to the next and last key for trading in a smaller account, and really that's going to be cutting losses. So I had a position on pretty much right when I started the account, and really when I started getting involved on the follow page, I sold a put in GoPro. I love GoPro. I love GoPros. I use it when I go snowboarding, and I really enjoyed the market, and I thought that they were going to continue to go up because I personally enjoyed it, and I didn't see how they couldn't possibly go lower than where they were. And when I sold a put, they were trading at about 33, and I believe I sold a 30 put. And of course, if you look at GoPro now, I think they're trading around 13 or 14, and I actually did not cut my losses. I let that trade go all the way down to about 15 or 16. Luckily, implied volatility was high enough to where I was able to roll it 2 or 3 times, and I was able to collect about $500 in extrinsic value, which offset my loss. But at the end of the day, I did bring it down to, it was about a $1,500 or $1,400 loss, I believe, when I was closing the trade altogether. So when I think about that trade, if I were to have cut that loss and managed that position at 2x my credit received, which is what we've shown to be optimal based on our research, I would have saved myself probably around $1,200 or $1,300, which would put me up even further in terms of profit than I am right now. So when we're looking at cutting losses and controlling them, I think it's super imperative for smaller accounts. So when we're looking at smaller accounts, we don't have the luxury of holding trades until we're right. So if I had a $100,000 account and I sold that put, maybe I wouldn't have had to take that trade off, because even if I sold a put at 30 and the underlying went down to 15, I would only be seeing about a $1,500 loss or less depending on the credit I received. So when I compare a $1,500 loss to a $100,000 account, it's like pennies compared to a $10,000 account where it's a very big portion of that portfolio size. So when we're dealing with larger accounts, we have the luxury of potentially holding naked options until we're right. I know a lot of traders do that, and they just hold it and continue to roll it and hope that the underlying will eventually come back up and put their option out of the money. But for smaller accounts, I think it's really important to control the losses so that we don't get wiped out by one position, where I was brought down about 10% just from that one position that I had. And really, capital can be used efficiently elsewhere. So instead of holding that position, I could have taken that off and moved that same buying power that was being used into a new position with a much higher probability of success and probably around the same amount of credit in terms of extrinsic value that I could have received. So when we think about rolling, it's important to understand, yes, we have an assumption and maybe we want to get out of that trade for a profit, but we also have to measure that trade, measure the credit we're receiving against the buying power, and really think about whether we can use that same buying power in a more efficient way with a higher probability of success. So when I say cutting losses at 2 times credit received, really what I'm talking about is the premium we receive. So let's say I sold a put for $2 of credit. If I wanted to get out of the trade at 2 times credit received, I would actually put in a resting order where I would be buying back that put for a $6 debit. Because if I sold the put for $2 credit and I'm able to close it out for a $6 debit, that's actually a $4 net loss. And that net loss is really what we're looking for when we refer to our 2 times credit received. So when we're placing trades and really looking to set up stop losses on our positions, we would be putting our stop loss at this $6 value here if I were to theoretically collect a $2 credit for that put, because that's what would get me to that 2 times net loss. So if we're looking at 2 times net loss on the credit received, we really want to put our closing order at 3 times the credit we received on a gross perspective. So let's wrap all this together with some takeaways for you. The first takeaway we've got is that we can still beat the market in a smaller account. It's just going to be a little bit harder. So I think the biggest key is staying small, and really staying small in a smaller account can be difficult because of the underlyings that are the most liquid, usually tend to be higher priced underlyings, but we can use defined risk and other aspects of trading to keep that buying power lower and really keep us in that 1 to 5% range, which I think is optimal when we're looking at a longer term perspective and making sure that we're not putting ourselves at too much risk. And really staying small, but also managing losers and understanding the strategies, and really understanding the strategies in terms of getting in, getting out, and most importantly, how to manage are going to be the keys to success for trading in a smaller account. So thanks so much for tuning in. If you've got any questions or feedback, or if you've got any stories you want to share with me about trading in a small account, shoot me an email here, or you can follow me at DoTraderMike on Twitter. Stay tuned though, we got Jim Schultz coming up next.
Hey there, hope you liked this video. Click below to watch more videos, subscribe to our channel, and check out tastytrade.com for more great research and content.